Running a business generates a constant stream of paperwork. Receipts, invoices, and ledgers accumulate quickly, and it is easy to treat organizing them as a secondary concern, handled only when time permits. That approach lasts until the state steps in. Section 62 of the Income Tax Act removes personal preference from this process. It is the specific statute that dictates how the government expects you to record and report your financial history. To calculate your total taxable income, an assessing officer requires more than a summary. They need a trail of verifiable evidence to confirm that your reported figures match your actual commercial activity. While the law mandates formal bookkeeping, the specific requirements are not applied universally. Whether you are legally obligated to maintain these records depends on how the tax code classifies your profession and your annual revenue. Operating without identifying your Section 62 classification is a significant risk. If an audit occurs and mandatory records do not exist, you lose the primary means of justifying your income to the authorities. The logic of the law follows two primary paths, splitting all taxpayers into specified professions and all other businesses. The Act defines a specified profession as an individual working in law, medicine, engineering, architecture, accountancy, technical consultancy, interior decoration, information technology, or as a company secretary. For anyone in these fields, the law is absolute. Maintaining books of account is a mandatory requirement from day one, regardless of whether the practice is just starting or generating millions in revenue. This list is also subject to change. The board maintains the legal authority to notify and add new professions to this mandatory category whenever they deem it necessary. In these industries, your professional status alone triggers the requirement. The state treats these roles as inherently sophisticated enough to require full financial documentation from the start of operations. The second branch of the tree covers all other general businesses and professions not on that specific list. For this group, the obligation to keep books is triggered by specific financial milestones. If your business crossed a financial limit in the 3 preceding tax years, you must maintain records. Limits are reached if annual income exceeds 1,20,000 rupees or turnover exceeds 10 lakh rupees. Newly set up businesses follow the same logic if projected to cross these exact lines. Because the law uses the word likely, a new business must track its growth closely. If the trends suggest you will exceed the income or turnover limits, you are expected to have your books in order from the start. These figures serve as a clear boundary. Once a venture reaches this scale, the state no longer views it as a minor activity and requires documented proof of all financial transactions. While the 1.2 lakh rupees and 10 lakh rupees rules are the standard, the tax code provides higher thresholds for individuals and Hindu undivided families. For this group, the requirement only kicks in if income exceeds 2,50,000 rupees, or if the total sales and turnover surpass 25 lakh rupees. These higher limits offer significant leeway for smaller family-run operations. However, there is a specific action that overrides all these thresholds. It occurs when a taxpayer chooses to use the presumptive taxation schemes under Sections 58.2 or 61.2. If you claim that your actual business income is lower than the government's deemed profit percentage for your industry, you trigger an automatic requirement to keep books. The scale tips because you are now challenging the state's baseline assumptions. When Section 62 applies, the board defines exactly what books means. They prescribe the types of documents and inventories required, the forms they must take, and how many years you must retain them for inspection. Presumptive tax is an administrative shortcut. If you choose to report profits below that standard, you carry the burden of providing full, documented evidence to support your lower figures. An audit reveals the difference between an undocumented business and one prepared for scrutiny. Without records, you are left to negotiate from a position of uncertainty. With them, you have a documented defense. These records serve as the primary evidence needed to prevent the state from making arbitrary estimates of your actual income. Evaluate your own business against these criteria today. Compare your profession, your legal structure, and your recent turnover against the logic of the Section 62 decision tree. Mastering these classifications allows you to align your records with the specific demands of the Act. When your documentation matches the legal requirement, your financial history becomes a matter of verifiable fact.